In May 2021, Dogecoin price surpassed 70% and hit a value of about $93 billion. Sadly, it didn't stay that way too long. Its value dropped and over $66 billion of wealth was totally wiped out. One of the reasons why Dogecoin kept rising from $50 to $70 and then over $90 billion is because, on the other hand, there were people who paid so much to buy Dogecoin, and at the end of the day, what motivates the price as any type of assets is its demand and supply. Some enthusiasts believe that Dogecoin will rise again, but the truth is, it may or may not rise, and this is normal in the world of investing. You never know what would rise and what would not rise. So, in this video, I'm going to share with you 5 investing mistakes to avoid. Before we begin, I want to point out that this video was not made for financial advice, but for educational purposes. So, let's begin. The first mistake to avoid is listening to the quote-unquote big guys. When some of us enter the financial market, we start reading what the big guys are saying, such as JP Morgan, Wall Street, and so on. You would think that because these guys have been in the financial market longer than you, they probably know what's better. You would look at them as professional investors, having thousands of economists and analysts working for them. So, if they say an investment is safe, then it's safe. But the truth is, you should never trust what these people are saying, because they usually talk if it's in their own interest, which is not reality. Back in 2004, when the housing market was in a bubble, the dean of the Columbian business school, Glen Hubbard, was paid to co-author a paper with some chief economists, where they praised derivatives. The derivative market of that time had improved allocation of capital and risks, and were enhancing financial stability. Meanwhile, in reality, the derivatives were creating this bubble, and it would burst sooner or later. Even Warren Buffett warned everyone that derivatives are financial weapons of mass destruction. This is just one of many examples. Other people were paid to say that Iceland's economy is very stable and the housing market will always keep rising. Meanwhile, they were one of the first countries to go bankrupt in the 2008 crash. Many people invested based on what these economics and professionals said, while others went so far that the 5 Lehman Brothers executives destroyed their own company just to fill their pockets. They made over $1 billion. Anytime you want to invest, understand the market yourself. Do not rely on authority. Never rely on what professionals are saying. You could always read their opinions, but at the end of the day, make your own decisions based on your own understanding of the market. The second mistake to avoid is not understanding debt. The stock market is already slightly complicated, but most people can figure out how it works within a short amount of time. What most beginners don't understand is that leverage in it and how it can lay an impact on a particular asset. Sometimes in the news, you see things like traders use 100-to-1 ratios when trading Bitcoin. Most beginners don't understand that, and if you don't, do not invest in it. When you also do your analysis, find out if an asset is going to double or triple. Leverage can destroy everything. Leverage 100-to-1 means traders are borrowing $99,000 for every $1K they put themselves. Let's use an illustration to explain this better. Sarah is an investor, and she just has $1,000. If she makes a 10% profit, that's $100. But if she borrows $99,000, she's now trading with $100,000. If she makes a 10% profit, that's now $10,000 and not $100. But, as usual, the more profits you make, the riskier the asset. But if Bitcoin prices drop by 10%, which is very normal for an unstable asset such as crypto, your broker would immediately sell all of your positions in order to minimize losses. In fact, he would sell them at the lowest price possible to remove your position as soon as possible, because you have no money left to trade. And if the broker would not get his $99,000 back, you will owe the broker the remaining amount plus interest. Now, you must be wondering, how is this going to have an impact on you? If one trader goes bankrupt, that's mostly not a big deal. But when leverage is mostly used in the market, then there would be an oversupply of that asset in the market, even if the price drops slightly. When the supply is higher than the demand, it would lead to a decrease in price, which would make more brokers remove the position of their clients. It's just like the snowball effect. All of a sudden, an asset with valuable technology goes down to zero. Though some of you might say that it is a profitable asset, there would be a high demand for it, or there is a limited amount of Bitcoin in the demand, so there would always be a demand. But Unlike a fiat currency, there is a promising technology behind, which is true, but people say the same thing about the housing market. A house is a type of asset that you can feel, touch, and use, and there will always be a demand for shelter. It's one of the oldest assets in history, yet leverage destroyed it. So, before you invest in any asset, find out how much leverage is involved. The third mistake is not seeing the big picture. When you throw your money into the stock market, you start getting scared once the stock prices drop. The fact is, daily ups and downs don't really matter. They don't even tell us how business is doing on a daily basis. One rumor can reduce the price or increase it, and that is how the stock market works. It moves based on people's perceptions about the company and its future. But if you are a long-term investor, you should not worry about that too much. For example, let's look at Tesla. It had its moments when the stock prices dropped by 20, 30, and even 50%. But if you look at the chart, the stock has increased to over 18,000 since it went public. Those people who saw the big picture and potential in Tesla ignored these dips and kept holding their stocks. Tesla is just one, for example. There are millions of other examples. Amazon has grown to over 100,000 since it went public. So, before you invest in a company, find out its strategy and where it will be in the years to come before investing. Number 4. Not investing in knowledge. Most people overrate themselves. They watch some videos on YouTube and see themselves as investing experts, explaining why Shiba has more value than the US dollar and that people like JP Morgan are losers because they haven't invested in Shiba yet. There's a popular adage that goes, you learn more when you find out you don't know. The reality is, more retail investors lose, and even hedge funds that charge astronomical fees trying to beat the market don't lose. The information you get on YouTube or on the internet is usually for entertainment purposes to get large views. It's not worth it, spending so much time creating videos on YouTube when not enough people watch it, so be careful what to rely on and what not to rely on. Find reliable people, whom you trust, and who have much experience. Also, invest in professional courses, the ones that would give you more insight on how the market works and how to read financial statements and so on. Knowledge is key. Lastly, not having a clear plan. One of the reasons people enter the stock market is to make money. But what most people don't pay attention to is their investment strategy. For example, if you hold index fund stocks, you should not even follow the stock market. Your end goal is to build wealth for a long period of time. If your strategy is to pick up the right company that would dominate the sector, then you should take a different approach to invest and focus on a different factor. When you don't plan before investing, you make a lot of mistakes. You start reacting emotionally to the ups and downs, and you would make decisions that would destroy your portfolio. That is why it's advisable to start small when you're going into investments. Don't put all your money into one asset. Once you try a few stocks, you would have knowledge about what everything is all about. What's the worst investing mistake you have ever made? Share your experience in the comment section below. If you enjoyed this video, give it some thumbs up and make sure to subscribe if you haven't done that yet.